It might surprise you, but there's quite a few really good companies trading at 52-week lows.
We're talking about 7 beaten down stocks trading at 52-week lows.
We're basically getting down to COVID era lows here. The cheapest prices we've seen in about 5 years, right? If you're exciting, if you have anything to do with chatbots and AI and personal assistants and singularity and all these things, Skynet, you're trading for massive multiples. But if not, you're trading at a discount.
I wonder what it would be like if we just built a portfolio of these 7 stocks and tracked them over the next, say, year or so.
Great companies tend to keep marching higher, and I suspect that's what all 7 of these will do over the long term.
Hello, everyone. It's Brad Thomas, and welcome back to the Wide Moat Show. I'm joined today with my co-host, Nicholas Ward. Nick, it's great to see you today.
Yeah, great to see you, Brad. Happy to be here. I think the government shutdown's ending. Hopefully by the time this video goes live, that will be the case. And, hopefully we'll see a market rally this week.
Yeah, well, I want to ask you, too, about, I know you're nearing your football coaching, career this year, at least. So how'd you do this weekend?
Yeah, hopefully the government shutdown's coming to an end and our season is coming to an end. Hopefully not too soon, but we're getting there. Yeah, we finished up the regular season this week. We won 27-0. So our third shutout of the year. Couldn't be prouder of the guys for that. 7-3 record we just sneaked into the playoffs. We are the number 8 seed in our region out of 8. So that means this Friday we have to drive about an hour and a half south of here and play the number 1 seed. So we'll see. They're a good team. They got some good athletes, but so do we. So anything can happen when you get into the playoffs. And here's to hoping that this time next week, I'm talking about playing in the second round.
Well, there's big stakes on the Underdogs, so we'll be watching that one closely. Look forward to hearing back next week. Now, Nick, this week, we're going to be talking about a topic that I know some of our followers have been asking for. And by the way, any of you watching this, please drop comments below because that helps us create content for episodes just like this. I know several of our followers have asked about some of these really, really cheap bargain basement companies today that are trading at 52-week lows.
Yeah. You talk about we're the underdog in football, that we're talking about underdogs in the market this week. That's kind of where Brad and I sort of butter our bread. We buy beaten down blue chips. We take advantage of irrational weakness in the market, and therefore get to benefit from not only fundamental growth, but also multiple expansion. So we want to talk about values today. The topic will be high quality companies at 52-week lows. And with the market near all-time highs, it might surprise you, but there's quite a few really good companies trading at 52-week lows. So to start the video off, I'm going to talk about why that is. And then Brad and I will get into our picks that we like, that are out of favor. So first of all, I'll put up a chart here. And this is the S&P 500 on the year. We're up about 16%. It's been a great year. I think coming into 2025, Brad and I know for our front end newsletter, I think we projected, 8 to 10% growth, just kind of a normal year. We're coming off a couple of strong double-digit years, and it's rare to have 3 of those in a row. But it looks like that's where we're headed. So 2025 has outperformed, I suspect, most people's expectations, up 16%, especially with a lot of the volatility that we've seen with tariffs, with political stuff, with wars, etc. There's a lot of kind of fear factors for the market to clear, but they're doing it, and that's great. However, when you look at this chart, this is the S&P 500 equal weighted. You see the market's only up 7.5%. So the difference here is the S&P 500 is a market weighted index. That means the largest companies make up the larger share of the index. Companies like NVIDIA, Apple, Microsoft, etc. They're 5, 6, 7, 8% of the index. However, on an equal weighted index, everything is the same. No company is more important than the other, and therefore you get a perfect average of how the S&P 500 companies are doing, and that's only 7.5%. And the reason that is I looked at the top 10 holdings of the S&P 500, and you'll see this is kind of a market of haves and have-nots. If you have anything to do with AI, you're having an amazing year. If you don't, you're probably underperforming. So NVIDIA, the top holding in the S&P, is up 46.4% right now. Wonderful year. Apple, who is kind of lagging in AI, is only up 7.7%. Microsoft, 19.4%. Tesla, 10.7%. Amazon, 13.2%. Google, 50.2%. Broadcom 54%, Meta only 8%. So you see how this goes. You're either a winner in the AI, and if you are, the market has rewarded you in a major way. And if you're not, then you're just having a kind of average, 7 to 10% year, good year, fundamentals are rising, etc. But these big companies, the NVIDIAs, the Googles, the Broadcoms, etc. That's why the market weighted index is up almost 20% or 16%, excuse me. And that's why a lot of great companies are underperforming. So this shows the S&P 500 sectors. And as you can see, information technology and communication services, which is a bit misleading because communication services has like social media companies in it. So basically tech companies, they're up 20%, but then you have consumer staples up 0.2%, basically flat on the year. You have real estate, which Brad and I love to cover here, only up 1.6%. Materials and energy, single digits, so it's definitely a market of have and have nots. And so that's been a beneficiary to people that own tech, but we think it's opening up opportunities to kind of buy the out of favor sector. So Brad, what do you have to say about that? Anything on the macro point of view before we get into our individual picks here?
No, I'm excited to talk about the picks. Actually, I could say all three of my picks actually have some technology bias, and I'll get into that in just a minute when I get to my side. But let's start with your picks.
Yeah, well, we can start with mine. Maybe we can alternate, or I'll go 3 in a row. We'll see. But number one that I wanted to talk about is a company it's very hard to find at a 52-week low. It's also a company that's pretty hard to find with like a 3% dividend yield, which we're getting really close to now. And I'm talking about Procter and Gamble, ticker symbol P&G. About as boring as it comes. I pulled up all the things that they sell. Here's their brand list. You've got diapers. You've got fabric care. You've got laundry detergent. You've got soap. You've got, paper towels and toilet paper. You've got toothpaste. You've got feminine care. You've got grooming, razors, all sorts of very boring things that you find in like the kind of the expensive aisles of the grocery store that you hate going down, that you have to buy no matter what. You have to have soap. You have to have toilet paper. Most people shave. I don't buy a lot of razors, but most people do. Things like that you don't have a choice to buy. Sure, you can buy off-brand. You can buy store brand things, generic products. However, I think a lot of people do understand the quality is there with the kind of technology that Procter & Gamble has. They have invested a lot more money into R&D than a lot of their competitors over the years. So, their laundry detergent might do a little better, etc. So this company is at 52-week lows. It's at $147 a share right now. That's roughly 21 times. And as you can see on this fast graph, we're basically getting down to COVID era lows here. The cheapest prices we've seen in about 5 years. Yeah, coming out of the Great Recession, you can see the black line here dipped well below. The jagged black line dipped well below the kind of straight black line, which represents the current share price. This was traded for 14, 15 times back in kind of 08, 09. But that's as cheap as we've ever seen it. So 21 times for this company, that's a historical discount. Procter & Gamble's average premium during the last 10 years is 23.3 times. And during the last 5 years, it's 24.2. So you're looking at about a 10% discount to kind of the more recent historical averages. The dividend is quite safe. They're paying out $4.08 a share this year. They're expected to earn like $6.85. Fine coverage there. Low to mid single digit dividend growth. There is not a single thing that is exciting about this company, but it's about as reliable as it comes. So 2.9% dividend yield, growing at 4 to 6% a year, I think is sort of what you can expect moving forward. So you're going to beat inflation, most likely. You're going to compound your wealth. You're going to kind of be able to extend your purchasing power over time. A lot of people might not be interested in that, but if you're a retiree or someone, on the more conservative side of the investing spectrum, now's a pretty rare opportunity to buy Procter & Gamble down near here, historical lows and during about the last decade.
That's great, Nick. I like that pick, and it is a real boring pick, as you say. I hope your next one's a little more exciting.
It's not, but that's okay. I think that's why these companies are at 52-week lows, right? If you're exciting, if you have anything to do with chat bots and AI and personal assistants and singularity and all these things, Skynet, you're trading for massive multiples. But if not, you're trading at a discount. So the next company, I wrote a Wide Moat Daily on this last Friday. So there's the pitch to that. You can go to widemoatdaily.com and check those out, or widemoatresearch.com and click the link. Automatic data processing. Even the name of this company sounds kind of boring. This is the largest payroll company in the world. So every time somebody gets paid, there's a pretty good chance that it's being processed, and the technology, kind of back end technology that ticker symbol ADP offers, is involved. With that in mind, this company is about as consistent as they come. It's a very basic business model, but they have a wide moat. They have great services. Companies don't want to really switch once they get involved from a IT standpoint or from a human relations standpoint. It doesn't make sense. So this company has produced positive earnings growth during 19 out of the past 20 years. And the only miss they had was in 2010, and that was a 2-cent miss, a less than 1% miss. So this company grows, you can bank it. Every year you're going to get positive growth out of this company. They grew 9% in their fiscal 2025. They're expected to grow 9% in fiscal 26. There's a lot of negative pressure on this stock recently, and I think it has to do with the AI headwinds. You hear a lot of people talking about the 3-day work week as white collar jobs disappear. Maybe UBI having to get paid by governments, as if people can't find work. There's all these statistics on entry level workers, especially in kind of white collar industries. College graduates can't find work right now. It's actually a really tough job market for a lot of people, in large part because big corporations are investing in AI and letting their AI bots essentially do these entry level jobs. So no, I don't know what that's going to turn into. I don't know how many of us will be working in 10 to 15 years, et cetera. If you are a believer that AI is just going to wipe out human jobs, probably avoid this stock, because if we don't have jobs, we're not going to get paid. But if you are on the other side and you think this is going to be like every other technological revolution that we've seen in the last couple hundred years, where sure, some industries get wiped out, but then it creates new industries and human beings kind of just keep marching forward, then it's a great buying opportunity. The stock's trading for less than 25 times. Its long-term average is 25 times. So not a huge bargain, but if you look at this fast graph, you'll see you haven't had a chance to buy this stock at this multiple since the COVID sell-off. So that was kind of a once in a generation bear market. And here we are. During the last 10 years, the average PDE here is 28.5 times. So we are at a pretty significant discount to that. And during the last 5 years, it's even higher at 28.4 times. So, 28 times is kind of where this has been for about a decade. We're at 25 times now. The stock's expected to grow at 9% during each of the next 3 years. The 2.4% dividend yield, so more than twice of the S&P 500, which yields about 1.1% right now. And this company has been consistently compounding that dividend at about 10% a year for as long as I can remember. So from a dividend growth standpoint, it doesn't get much better than ADP. Very reliable dividend. The payout ratio is still very low. I expect to see this company continue to compound its dividend at kind of that 8 to 12% range, well above inflation. So if you can stomach the 2.4% yield, then you're going to, your purchasing power will increase much higher than inflation moving forward. And that makes, that's what allows me to sleep all at night. This is the type of company that I love to own. I don't currently own it. I sold it. As you can see on the fast graph, this company got way overvalued in recent years, and I took that opportunity to trim it. But now that it's back down near the lows, I'm going to, it's rising up my watch list. And, maybe the next time that we do a Nick's portfolio recap video, you'll see that I do own ADP in the future. So wanted to put that out there. This company is rising up my watch list, and I think it should be on, dividend investors' radars everywhere. Anything about ADP, Brad?
Yeah, no, another good pick. You're right. It's not terribly exciting, but everybody likes getting paychecks, and so but definitely undervalued right now. And I like that 9% growth forecast as well. So another great pick. So let's move on to number 3.
Yeah, it's funny. Like if you're not growing at 38%, people start to hate you, but 9% EPS growth, that is nothing to scoff at. That will generate a lot of wealth over the long term. Especially if it's consistent. This next pick, the issue with it is it's losing its consistency. This was a company growing at 30% a year for a long time, and now it's not. And because of that, I don't think the market knows where to price it. I'm talking about Zoetis, ticker symbol ZTS. This is a company that spun off of Merck, I think. I think Pfizer. Merck still has their animal health department. It's an animal health company, so biopharma for your pets and for livestock, etc. I like that industry because there's not as much regulation involved. To get a drug into a human, you've got to go through all these trials, and there's a lot that goes into it. And there's a lot of competition. There's not as much competition in the animal space. Obviously, there's still trials involved. We can't just, mutate animals or anything. And especially a lot of these animals turn into food. So there are regulatory bodies that track this stuff, but there's only like 3 companies that are really big into this industry. And this is one of them. Here's the fast graph. As you could see, this company's been growing at single digits for a while now. The last 3 years, I guess last year was 11%, but the 2 years before that, and then this year we're in the single digits. That's a big anomaly. For the first, 5 or 6 years this company was public, it was growing at 25, 30% a year. It was a wonderful company. And because of that, it was trading for 30 times. It was an expensive stock. It was a growth stock, a dividend growth stock. We're talking 15, 20% dividend growth per year. It was a wonderful company. I owned it for a while. But as you could see, post-pandemic, its valuation shot way up. So I did trim this a few years ago. I no longer own shares. But now the stock's at 19 times. This is the cheapest valuation that we've ever seen since the spinoff on this company. You can see that once again, the kind of flat black line on this chart represents the current share price, and the jagged line, which represents the share price, has never gone that low. So I'm always happy to buy a blue chip at historically cheap valuations, and that's what you have here with Zoetis. The company's still expected to grow at 7 to 10% a year moving forward. So solid growth, 1.7% dividend yield. I think we're still talking 8 to 12% dividend growth here. So all the fundamentals are good. It just comes down to the question of where should it trade, growing at 8% a year instead of 28% a year. I don't think the market's figured that out yet. It could go much lower. Maybe they decide this is a stock that deserves a 15 times multiple. We see some of the big human biopharmas like Pfizer, Bristol Myers, et cetera, trading in that kind of 12 to 15 times range. Maybe ZTS will go there. I don't know. But that would be a massive sell-off from where it's been. And I still think all the kind of tailwinds regarding the lack of competition and the lack of regulation on a relative basis remain in place here. This company is dealing with some, I think they had like an arthritis drug for dogs that some people said killed their dog. And then there was a social media thing, there's some headwinds that they have to deal with, but they're still the leader in a lot of things: Lyme disease, livestock stuff, arthritis, dermatology for pets, etc. If you have a pet, you kind of know, you get all these little things, and most people treat their pets better than they treat their sons, their daughters, their wives, even. People love their pets. Jim Cramer has kind of talked about that personification of animals for a long time. This is a big winner from that trend. It hasn't been a winner over the last couple quarters, and now you have an opportunity to buy it at an historical low valuation. So if you want to own some animal healthcare, I think now's maybe a time to take a look at Zoetis.
Another good pick, Nick. I was not familiar with that company, but definitely you're right. There's tremendous demand for pets, and I remember when I built my PetSmart store, I learned that there is a lot of people that will spend a lot of money on their pets. So definitely good pick here.
Yeah, and then here's my bonus pick. Brad and I said we're going to do 3 each, but I've actually been buying this company in the last couple of days, and so I kind of feel remiss not to mention it. I know you guys love it when I talk about my personal portfolio. So this is the first time ever that I've owned this company. As you can see on the fast graph, it's at 52-week lows. It's at the cheapest valuation we've seen since, I think, 2015. I'm talking about Brown & Brown, ticker symbol BRO. They're a insurance brokerage company. I've talked about MMC before. I still own MMC. I like them. They're kind of the biggest player in the industry. Brown & Brown is sort of the smaller, faster growing player in the industry. Maybe MMC is the Visa and BRO is the MasterCard type of comparison here. So very high quality company, very consistent growth, as you can see on the fast graph. The dividend is shooting up year after year. I expect 10% growth there moving forward. The yield is slow at just 0.8%, less than 1%. So I know a lot of people are just going to immediately just cancel this one off of their watch list, but I'm not buying this for income in the present. I'm buying this because I don't think insurance is going anywhere. You're seeing tariffs and sort of natural disasters kind of mess with the market. There's premiums are rising. There's a lot of uncertainty. So that's hurting the industry in the short term. But when I think about the future, I can't imagine a future where humans aren't insuring their property, their health, their lives, etc. Insurance is just a big part of the modern world. And I'm happy to buy blue chip companies from this industry into weakness. And I do like the brokers because they're not really offering that, if this company is, if there's a massive, wildfire somewhere, they're not going to be stuck with billions of dollars of losses. They're just selling products. They're kind of the intermediary. You need that, especially highly wealthy individuals or companies. It's a very complex situation. So they use companies like this to find the best deal. So I like Brown and Brown here. That's kind of the bonus pick. I've been buying them at around this kind of 76 to 77, $78 area. Small position still, but if the stock, the more it goes down, the more I'm going to buy. And this is definitely a company I could see kind of creeping up into my top 20, top 30 holdings. So there's my bonus pick. Once again, another 52-week low, historical low. You got to love it. Like I know AI is great. Technology is great. You guys have seen my portfolio. I own just about all the big tech companies, but I don't need to own all tech companies. I'm very happy to take advantage of weakness elsewhere. And that's what these 4 stocks give you the opportunity to do.
Great. And I like that insurance pick, Nick. And I like the fact you did a bonus pick. You've got 4, I've got 3. So we're talking about 7 beaten down stocks trading at 52-week lows. So you got an insurance pick. I've got one too. This is Progressive Corporation, PGR. This is one of America's greatest financial companies with a track record of growth and stock performance that goes back to the IPO in 1971. Now, I put a chart up here. You can see that Progressive has outperformed both the S&P 500 and its rival Geico, which is owned by Berkshire Hathaway, over the last 5, 10, and 20 years. I put together a 15-year chart here. So you can see even with that 52-week pullback, Progressive has outperformed. Now, shares are definitely on sale now after falling 20% from their April peak to around $217 a share, including this 5% drop on the recent earnings disappointment, which was in September. Progressive is the number 2 auto insurer. Now, full disclosure, I don't own shares. However, I have 2 cars insured with Progressive, if that counts. I like to disclose everything. I don't know how it affect this, but I always like compliance. So does my employer. But Progressive is the number 2 auto insurer, second only to State Farm. The company is still expanding rapidly with their automotive insurance policies in force up 15% year over year. That number is down from about 20% last year. Pricing is coming under pressure as these insurance, and of course, I can feel that pain as the insurance prices rose by double digits in 2023 and 2024. Now, I have two girls, 2 daughters in Jeep, so you can imagine, they haven't had any wrecks yet, but definitely see those rates going up. Now, combined with these factors, you can see for this fast graphs here, analysts are forecasting negative growth, EPS per share, of 9% in 2026 and a lackluster 2027 with just 1% growth. But you can see this price is really dropped. That's the black line here with this fast graphs. Now, in addition to its A-rated balance sheet, Progressive possesses a technology advantage and is considered the industry leader in the space. The company was an early mover in this, what's called Telematics, which is real-time driving information and other analytics to price these automotive insurance policies. Now, with a market share of around 17%, again, this is just 2% behind State Farm. I think at some point, Progressive will overtake State Farm. They already overtook Geico, by the way, to become that second largest in the space. So another advantage for Progressive is marketing. Now, many of you are familiar with the brand, the pitch woman Flo, who creates brand awareness for this company. I've got our picture here. Everybody recognizes Flo. The company, so again, we have this technology advantage. They have a marketing advantage. They put a lot of money in their marketing efforts. As one analyst put it, Progressive is a technology company that happens to sell insurance. So there's not much research on this company. I don't see a lot of coverage, at least from an institutional letter. They don't really do these investor meetings. They don't attend conferences. They're based up in Ohio, so they're not in a major market. However, utilizing fast graphs, I do see 24 analysts with this consensus report. And again, I mentioned earlier, shares are cheap, trading at 12.5 times their projected 2025 earnings and 13 times estimated 2026 profits of 16.55 cents per share. So I suspect the company will increase its store buyback program. The CEO explained on the recent earnings call, quote, we're very cognizant with the shares under our intrinsic value. And we typically, if we have the capital, take action when that happens. So also, just like Costco, Nick, one of your favorites, Progressive also pays special dividends periodically when it has excess capital. So we're looking for the company for those special dividends, but they're also going to be buying back stock, especially with this pullback that we're seeing here. So I consider it definitely a good entry point right now. The 2-year annual total return target, this is an estimated 2-year target, is 25%. Again, that's annually. So buying today, the forecast we have here on Fast Graphs is 66% total return from now until the end of 2027. So Nick, any thoughts on Progressive?
No, you gotta love that. I'm sitting here wondering like what Flo gets paid to do these commercials, because I know probably 10 years ago she was a no-name actress. She probably didn't get very much, but man, she's like an international superstar now. So they hit a home run with her. Love to see them doing the market share. Yeah, and you know what's happening? Like my umbrella policy with State Farm just went up like 300%. I've been arguing with them for the last 2 weeks on like how to save me money, and they won't do it. So I might go to Progressive, like I'm sure there's a lot of people shopping around. So now is a great opportunity for kind of all these companies to come up with deals to take market share during these kind of turbulent times. And, in 2 or 3 years, it'll be interesting to see kind of who the top dogs are in this space.
For sure. And again, I think Progressive is number one market share, if I'm not mistaken, in Florida. And again, with all this demand, this migration in Florida, you can see how that business has really taken off. So now let's go to the second pick of mine. This will be our 6th pick overall. And this is a REIT. I haven't really covered this a whole lot, called UDR. This is an apartment REIT that generates a majority of its net operating income primarily from coastal markets. Now, I put a map up here. When I say coastal markets, 35% of that exposure is in the West Coast, 25% of that exposure is in the Sunbelt, and 40% of that exposure is in the Northeast and Mid-Atlantic. So they definitely are spread around across all of the coastal areas. Now, personally, I prefer Mid-America, ticker MAA, or Camden Properties, ticker CPT, because of the outsized Sunbelt exposure. But one differentiator for UDR, much like Progressive I just talked about, is technology, which means the company uses this data to make better decisions across all of its business lines. They assess more than 1 million data daily elements to understand resident satisfaction levels, while also leveraging AI to increase the predictive nature of these satisfaction scores to identify actions to increase customer value. UDR also uses this technology advantage in terms of capital allegations. So it drives its investment decisions related to deal sourcing, market selection, and targets capital allocation. I put a chart here showing this is the kind of technology advantage that I refer to. Now, the company also has a fairly good balance sheet. They are investment grade rated. That's triple B plus S&P, with sector leading weighted average interest rate, the lowest percentage of maturing debt among all of the apartment peers over the next 3 and 5 year period. The company also has $1 billion of liquidity with strong leverage metrics that include debt to enterprise value of 30% and net debt to EBITDA of 5.5 times. I put together this quick debt screener chart for UDR and the peers, and you can see the company has attractive debt metrics. You've got 28% debt ratio and 5.6 times debt to EBITDA. Now, I also put together a valuation screener. So you can see UDR trades at 13.5 times price to FFO. Now, that's not the cheapest in the apartment sector, but when you consider the company's balance sheet that I just talked about, the current multiple appears very attractive. Also, UDR's dividend yield is 5.1% higher than these investment grade rated apartment peers. Now, the company recently hit this 52-week low, which creates a real buying opportunity. Using this Fast Graphs tool below, or here, I believe UDR could deliver 20% annualized returns over the next 5 years, or potentially 50% from now through the end of 2027. So definitely a cheap REIT to consider. Now, my last pick, we've already talked about it last week, is Alexandria Real Estate. This is the first mover life science landlord. They own 39 million square feet of properties and 4.2 million square feet of clusters that are developed in these campuses around Boston, San Francisco, San Diego, Seattle, Maryland, Research Triangle, and New York City. Now, since I featured this company last week, along with the other life science peers, I'm not going to go into great detail here. You can always go back to the last episode of the Wide Moat Show here on our YouTube channel. However, just to recap, Alexandria trades at a considerable discount, 7.6 times price to AFFO, compared with its normal multiple of 20 times. As I mentioned last week, a dividend cut is very likely. However, I'm not sure how long we'll see this type of valuation. Perhaps the dividend is not priced in, but I could definitely see how nibbling into this position could be advantageous. I plan to interview the CEO, Joel Marcus, soon, so we'll keep you informed here on the Wide Moat Show. So, Nick, this is the conclusion of my 3 picks, your 4 picks. So we have 7 beaten down stocks trading at 52-week lows. I wonder what it would be like if we just built a portfolio of these 7 stocks and tracked them over the next, say, year or so.
I'm sure it'd be good. That's kind of like the dogs of the Dow theory, right? You take the 10 highest yielding companies in the Dow and buy them every year, and you usually do fairly well. High yields mean low valuation, et cetera. And I think kind of great minds think alike here. UDR and Procter and Gamble, that's both a play. They're down because of kind of consumer sentiment, consumer health fears. Obviously, our 2 insurance companies are down in tandem. And then we both highlighted a beaten down kind of healthcare, life sciences type company. So yeah, those are the areas of the market that investors have soured on. But as we know, the pendulum always swings back and forth. You look at these companies and you think, oh, there's no way I'd buy them. They're out of favor, et cetera. Well, in a year and 18 months, if I had to guess, I'd say people that look at these companies, look at these fast graphs down the road, there's going to be a big spike. You're going to wish that you had bought them at 52-week lows. Kind of human nature says don't do it. There's a million reasons why you shouldn't do it, but I'm always kind of in the camp of this time is not different. Great companies tend to keep marching higher, and I suspect that's what all 7 of these will do over the long term.
Yeah, no, I agree, Nick, and great job with your 4. And I want to thank you all for watching the Wide Moat Show this week. Please drop us some comments below, because this will help us create more content going forward. And Nick, we look forward to seeing you next week. I guess you got playoffs, so get ready for that. And by the way, I'll be in Florida next week, but we'll certainly check in there, and look forward to seeing everybody next week here at the Wide Moat Show.
Yeah, see you guys. Have a great week, and we'll see you soon.
Hi, everyone. Thanks for watching today's episode. Don't forget to like, subscribe, and comment below. Also, if you don't get enough of me and Nick, please check out our widemoatdaily.com. Thanks so much.